Again, my name is Trent Klarenbach. A little background on who I am. I grew up on a farm west of Etonia, Saskatchewan. There's one guy in the audience I played minor hockey with, so it was good to see Sean again. It was nice to see. Went a small to medium-sized farm. My parents encouraged me to go to university where I studied agricultural economics. I had no intentions on farming when I left for university. However, my third year and fourth year, my roommates, they had farming opportunities back home, which led me to want to farm also at that time. Now, in the mid-90s, the economics in the farms in general, and certainly in West Central Saskatchewan, were not conducive to going back to farm. However, I decided I was. We entered the transportation industry as a lease operator with Somerville Farms. You see those blue and silver semis going up and down the road. Eventually, I got out of the truck and started farming. My dad and I had different visions for agriculture, where the farm was going, and certainly different risk tolerances, as I was in my mid-20s and he was in his 40s. So you can understand that how risk tolerances change. I went farming on my own, undercapitalized, but I gave her all I could, and I grew as one of the first growers of Kabuli chickpeas in Saskatchewan. I tried coriander. I was the largest grower of coriander one year in Canada, right? So just trying to find ways to make farming profitable. And there was a point about 2006, I guess it was, where I capitulated. There's a saying in trading, when the price is moving sideways, if it doesn't scare you out, it'll wear you out. And I was both of those. I was scared of not paying my debts, and I didn't see any light at the end of the tunnel. Now, I'll show you some charts after, and if I understood how to read a chart back in 2006, I would have saw some optimism in agriculture at that time. Anyways, I left the industry, became an environmental consultant, purchased the company, grew it into one of the largest single-owner environmental consulting companies in the province, and exited that company and merged it with a land acquisition company, and then exited that here this fall. Along the way, after the merger, I was a silent partner, and my son introduced me to technical analysis. So I was trained as agricultural economics, so you can imagine what my response would be to lines on a chart, right? What lines on a chart, what do they mean? I didn't want to discourage him from chasing his dream of being a day trader, but I also wanted to raise some caution. So I said, you don't have enough time, we don't have enough money to make a full-scale analysis of an asset. To analyze an asset to its fully to decide if we want to invest in it or not. And he said, no, Trent, just technical analysis, right? So anyways, I looked into it, went down the rabbit hole, became a believer of technical analysis. So, and my analysis now is completely technical. My life has got better since I turn off the news and don't pay attention to the news. So anyways, a cheat code for grain marketing. I recognize this is a little bit clickbaitish and maybe a little cheesy of a title, but I think back to my first experience with the cheat code. My parents gave me a ColecoVision. I got a ColecoVision for Christmas packaged, and the ColecoVision was Donkey Kong. A few people here probably remember playing Donkey Kong, and on the ColecoVision, you could run Mario across the screen on the bottom level, go up the ladder, come back 2 or 3 steps, turn around, and jump into the next level. You could bypass the other ladders and other levels. A cheat code take you to the next level. So what I'm sharing with you today is what I believe to be a cheat code for grain marketing. And if one can understand how markets work and understand psychology of the market and themselves, then I believe that it'll take you to your next level of grain marketing. So I can't remember if I mentioned this or not, but I published 2 grain marketing newsletters. So about 2.5 years ago, I recognized what I described as an information gap, an information void in grain marketing. My friends who I live with or lived around in Kinnersley, Saskatchewan, and I play hockey in the Kinnersley Farmer hockey team. I was hearing more and more stories of contracts having to be bought out, and just kind of the lack of awareness. they're either ignoring the advice or weren't seeking the advice of what to do in that situation. So a friend of mine, he actually told me afterwards, he actually stayed home all summer. And there was one day when he was able to execute a position in canola that returned him $500,000, so that he had that money to offset what he owed the grain company. So I recognize there's some work to do on the grain marketing side. So I started publishing these 2 newsletters: the grain reports, grains and oil seeds, everything from durum to corn to hard red spring wheat, canola, soybean oil. Special crops report are exactly that. Your lentils, your canary seed, yellow peas, kabuli chickpeas. Oh, look at that. Okay, so I'm a market technician, and what I do is I analyze the markets, the charts of the market, the price action. So what I do is I look at where is the price now? Where has it come from? And where can it go? And I use this technical analysis, my technique, to remove the guesswork from grain marketing. So there is no one style of technical analysis. You can throw 10 technicians in a room and you're going to come up with some multiple of 10 different ideas and strategies for technical analysis. When you're studying this, it's important to find a strategy, a method that resonates with you. If it doesn't resonate with you, it's not going to work. I've looked at a number of different strategies, and I've probably mentored under 5 or 6 different people. And I don't adopt all their ideas and the strategies, but I found ones that work for me, and they resonate with me. I believe in them. So what is technical analysis? Analysis methodology for forecasting the direction of prices through the study of past market data, primary, price, and volume. It's really a study of the behavior of the market and the psychology of the participants. And we as human beings have always been motivated by fear and greed. If we're making money, for example, we want to make more of it. We're likely to stay in our positions. If we're losing money, we're fearful of losing more money, so we're likely to exit. And that, I think, is a good summary of what a market technician looks for. I focus on the price and not the noise of the market. The only known in the marketplace to me is what the price is. When I see news and I see headlines, I can't be sure that that information is accurate. I can't be sure that that information is timely. I can't be sure that it's been priced into the market already. I can't be sure if it's been interpreted accurately, and I certainly can't be sure if I've interpreted accurately. We are human beings. We are emotional creatures. Kelly had a nice presentation on that subject prior to this. So we're emotional creatures and we're full of biases. And that really affects our interpretation of the market. If you're long a position, so you're long canola, and the price is dropping, we will as human beings, we will look for reasons for the price to rise and increase and discount the negative news, the bearish news on why that price could continue lower. So what I try to do is I try to remove those biases and just focus on the price. So this cheat code for grain marketing. Today I'll introduce you to the 4 stages of market structure. And my labeling's wrong. And also talk about the emotions commonly experienced these 4 stages. Now the 4 stages of, oh, look at that. So we want to understand the market structure. And we want to really be trend followers. So if there's one thing you take away from this presentation today, is you want to follow the trend. Learn to identify the direction of the trend and learn to identify when the trend changes. If you can do that in your investing, in your personal investing, your long-term investing, your day trading, your grain marketing, you will outperform 90+% of the other investors, the other hedge funds, the other grain marketers. It's basically trend following is the foundation of successful marketing strategies. If you're a trend follower, you can make money in up and down markets. It does not matter. There's some great books written about the financial crises, and there were trend followers profiled in the books who made money as the market crashed. They knew to be short the market. They knew to be in cash because the trend was lower. The odds of the trend continuing in the direction are higher than the reversing of the trend. So the 4 stages of the market structure, they apply to all assets and securities. So this includes stocks, bonds, currencies, cryptocurrencies, farmland values, housing values, all commodities, Apple stock. It doesn't not matter. And it was interesting to see earlier when I saw Miss Kaylee Arnold's presentation. She had charts about interest rates and inflation on the screen that were very similar to the chart that I'm about to show you. So you've likely seen this chart pattern before. You will see this chart pattern on a 50-year General Electric price chart. You'll see it on a 10-year, 12-year, 13-year Bitcoin chart. You'll see it on a 1-minute Apple chart. You'll see it on a 1-minute Forex chart. All assets move in a similar price pattern. So you have the 4 stages of market structure. You have your stage 1 accumulation, your stage 2 markup, your stage 3 distribution, and your stage 4 decline. So here's the background of what they are. Your stage 1 accumulation, this occurs after a price drop. And this is where the price is consolidating while the buyers gain control of the trend. This is where you want to observe, analyze, and anticipate the trade. So readers of my newsletter and people that I discuss the markets with, they will be aware that sometimes this is a no trade zone. I don't see an advantage to being long or being short. I don't see an advantage to, to hedge your position. I just don't. The price is consolidating sideways, given no clear direction of the trend. So it's the accumulation stage. The stage 2 markup. Now this is where we want to be long the markup, or long the asset. The price breaks out above the accumulation stage. This is the bullish phase of the cycle, defined by a series of higher highs and higher lows. That's the definition of an uptrend: higher highs and higher lows. And we want to be long. We want to get long on the breakouts and buy short-term pullbacks. So when I capitulated in agriculture, was essentially right at the start of the markup stage. So if I might have stayed grain farming, I might have pushed through another year and continued on that path. Turned out to be the best thing that didn't happen to me, but nonetheless, that's how things can change in your life. If you understand where the market's going, you maybe push through that extra year. Stage 3 distribution. This occurs after a prolonged price advance, with sellers gaining control, leading to a decline in the prices. So you'll see the price had gone up, it's pulled back and consolidating sideways. This is where the buyers and sellers are fighting for control of the trend, not unlike the stage 1 accumulation, just at the different part of the cycle. Now, it should be aware that stage 3 distribution, the prices can go up, and that'll be continuation of the stage 2 markup. But eventually, the price will move in this manner in all asset classes, in all time frames. The stage 4 decline. This is the bearish phase of a stock's life, defined by, again, lower lows and lower highs. So that's the downtrend. Lower lows and lower highs. This is where you want to sell or get short. So the price has been going sideways, pulled back off the high, it's gone sideways, and it started to break down lower. This is our sign to get out of the market, to sell our durum, sell our canola, sell our peas. This particular chart I highlighted it in January of 2022 and had a bearish sell signal at that time when canola broke below my price index of 1960. And when that selling started, it dropped to $15, maybe as low as $14 really quickly. And, you know, it was just a way to anticipate where the price is going if you have an understanding of where the market structure. So in the decline stage, you want to sell short the fresh breakdowns after short-term rallies have exhausted themselves. So it's prices can always go lower. They can go to zero. It's that they have that potential. But when you're in a stage 4 decline, you just definitely don't want to be long any positions. You want to be out of your position as quickly as you can. So here we are. This is again the summary of the 4 stages of the market structure. And if you overlay some of the more common commodity charts after to show you where I think they are in this market structure. So again, I can't stress enough how important it is to understand the 4 stages of the market structure. If the news is bullish, and we all see all sorts of news headlines, there's a number of people on Twitter and social media have been forecasting a recession. They've been bearish. There's a couple of obnoxious people that come to mind. They're claiming that we're in a recession. They're claiming we're in a recession, but the stock market keeps going higher. They've been shorting the NASDAQ, shorting the Russell, shorting the SPY, shorting Tesla. It might be a good opportunity to short Tesla now, but in the past it hasn't been. And the problem is they've been embraced with a narrative that's met their bias, that they believed and they wanted to believe doom and gloom, I guess you might say. And they were ignoring that each one of those asset classes were in a markup stage, where you want to be long, not short the market. So another important, I think almost a superpower is to understand your emotions. And I'll share with you today the different emotions found, commonly experienced during all 4 stages of the market structure. I believe that emotions drive our decisions. They do mine. If I feel good, I want more. If I don't feel good, I want less. As I'm becoming more and more aware of my emotions and developing some emotional granularity, I recognize now when I'm having a negative thought, I'll feel that tightness in my chest and my shoulders that I never used to notice. And that helps me, having that awareness really helps me make some better decisions. So we really want to develop some emotional granularity. We want to understand what we are feeling, why we are feeling this way. And if we understand what we are feeling and why we are feeling this way, we can have some improved emotional regulation. So you don't panic sell necessarily, right? You don't get in that situation where you panic sell, or maybe you're starting to feel the market's always going up, and you can make some better decisions. It's a path that I've been on personally. Kelly had a great presentation prior to this. I caught part of it, touched on that, helping understand how you feel and developing some emotional regulation. I can't stress how important it is. So again, with improved emotional regulation, it will lead to improved decision making. I have made decisions spur of the moment in the heat of a conversation. And I usually end up regretting them. I overreact. It's been, perhaps you've had experiences like that too. It's been, they're happening less now than they used to because I'm improving my emotional regulation, but it's a challenge. So I believe that our bodies inherently know what's right for us. And I am learning that my wife's encouragement to trust my intuition. I used to second guess what I thought was right, what I should be doing. Variety of reasons why that occurred. It's occurring less now than I used to. So I believe that if we understand the market structure, we understand our emotions, we can learn to trust our intuition, or in layman's term, trust our gut. So what I've done here is I've overlaid the various emotions often experienced during the 4 stages of the market structure. So in the accumulation stage, as I said earlier, what doesn't scare you out can wear you out. And you enter in a state of depression. The price is never going up. This is futile. I don't know what else I'm going to do. And then the price will start to rise. And you'll have this experience of disbelief. Yeah, this can't be true. It's not going to last. It's a bear market rally. The price rises further. You develop some hope. Well, maybe I can get back to break even if this keeps going on. And then there's optimism. Eventually you feel belief. And then the market rises far enough that you're actually thrilled that, what was once worth $3 is now worth $6. And it keeps going higher. And you're euphoria. You have euphoria. I felt euphoria. I like to reference the Bitcoin, 2017 euphoria. Had no idea I was going to be wealthy beyond imagination, right? Perhaps some of these emotions were felt in 2020 and 2021 in your own businesses as the prices rose on a parabolic, almost a straight up line with your commodity prices. Eventually the trend changes and the price pulls back. There's profit taking. And you enter into a stage 3 distribution. And we often experience this sense of complacency. I hear it all the time. I've experienced it. The price pulls back, you've kept your position, and I'll talk about Durham a little more because it's close and near to our heart, West Central Saskatchewan, but it was worth $22 a bushel, and it pulled back to 20. And a common conversation was, I'm going to set my target at 22 because it was there. It'll get back there. It was there already. It'll get back there. Then it drops to 19, and you develop this complacency that the price is going to get back to where it was. The price drops lower, and you enter into a stage 4 decline, and then you start experiencing anxiety. And I've experienced all these emotions. It's horrible. You start sweating in the stage 4 decline and anxiety. And then the price continues at that level. And then you have denial. This can't be happening. Be darned if the price doesn't go a little more. Drops a little more below that consolidation. And you're starting to panic. I've got a grain buyer friend of mine. He says his phone will start ringing and he can sense panic in farmers' voices. He can sense panic in his overseas buyers at different times. And when he can start to feel that sense of panic, he knows the selling is going to increase and usually results in lower prices. It goes lower enough, you become angry, right? You become angry at your grain buyer, the grain companies, because they're screwing you, right? You get angry at them for the market screwing you. Nobody wants to pay for what food is worth. We get angry at our marketing advisors and our analysts. And eventually we get angry with ourselves because ultimately it's our decision for not executing. And then once your anger's over, you settle into depression. And again, I felt all these experiences, and you enter into depression and the market consolidates sideways again into the accumulation stage, and then the cycle reverses itself. So I had an opportunity to meet a young gentleman here this morning, and I was talking to him briefly about these emotions in the market structure, and he says, well, you could apply that to everyday life. I said, yeah, exactly, right? That's the market's no different. Some people say it mirrors our everyday life. So it got me thinking about my high school grade 12 year in Etonia. There's 500 people in my town, 15 people in my graduating class. I was this young, insecure, pimply teenager lacking confidence. And I needed a date for the prom. And I didn't have a girlfriend. Who am I going to ask to take to the prom? I was in a state of depression. And then I mentioned to my friend Conrad, and he said, yeah, I think Becky, she would be your date at the prom. And I had this disbelief, like, why would Becky want to be my date at the prom? And then he started telling me more about it and gave me some hope, and then there's some optimism, and Becky smiled at me in the hallway, and I started to believe she might be my date in the prom. And the next day, she actually said hi to me, right? So, wow, right? I'm thrilled. I became euphoric. I'm gonna have a date for the prom. But it was Friday, and I didn't want to risk her saying no. So I became complacent, and I'll ask her Monday, because that's what I do. I put things off, right? Tough decisions, tough conversations. I became complacent. And then Monday rolls around, I go to school, and my buddy Conrad told me that little Johnny, was seen talking to her at the party. And I started developing anxiety. And then a couple days later, I found out that Johnny's got a new prom date, and it's Becky. And I was in denial. How can this happen to me? I thought she was gonna be mine. And then I started to panic. And then I was angry. I was angry at Becky for saying yes to Johnny. I was angry at Johnny for asking Becky, and eventually I got angry with myself. And then depression set in again because I had no date for the prom, right? So, stupid little story, but these emotions impact us in our markets and our everyday life. So I think it's developing emotional granularity, and just have some awareness of what we are feeling and why we are feeling that way. I think can be so powerful and help our decision making. It's making me a better person, a better husband, a better father, a better friend, and certainly a better trader. I actively trade the markets. It's making me a better analyst, because even though I just focus on the price, I'm subject to emotions and biases too. So again, improved emotional granularity equals improved decision making or marketing, right? So it becomes a bit of a superpower when you can be aware of your emotions and why you're feeling that way. So the market structure, I give you some examples of what the 4 stages of the market structure, and what I've did with these next slides is I've overlaid some of the common crops grown in Saskatchewan here, just to give you an idea where we might be in the market today and how we could use this information to avoid some of the drawdowns that we may be experiencing now. So I created this CWRS weekly price chart. Again, you can find this maybe on CWRS, but you can find it on the General Electric chart or Apple or Canadian dollar chart too. So I started this chart in 2020 at kind of the breakout of the markup stage. And interestingly enough, in my first newsletter, the Klarenbach Report, at that time I was covering everything from stocks to Forex to cryptocurrencies and some grain markets. And it was too much, so then I didn't continue with that newsletter in that structure. But I wrote in there on, I think it was September 6th or 9th, 2020, I talked about the coming of the golden age of agriculture. And why did I think that? And it was because I saw soybeans, I saw corn, I saw opportunities in wheat and canola where this could be the start of a a bull run. I started the stage 2 markup in those crops. Now, I'll take credit for recognizing its potential. I did not have any idea these prices were going to go as hard as they or as high as they have, or how high as they did. But again, it's interesting how the charts can predict this. So anyways, yes, we look at this hard red spring wheat. We can see, I think we're in a stage 4 decline. I think there's still room to go lower. It won't go lower in a straight line per se, but we're in a stage 4 decline, so I need to trust every rally as a bear market rally. There's a couple rules to follow. I don't show them in this presentation, but if you're going to start looking at charts, I suggest you put a 50-day moving average, or a 50-period moving average, and a 200-period moving average. And anytime you're below those two moving averages, you want to be short or be out of the market anytime you're below a 50-day moving average and a 200-day moving average, for example. And we're below those levels right now. Again, Durham, you can see where that price drop in the distribution stage, that was probably around, 16th of January, 2022, I believe. December that year, I had a price sell level signal, and then I rose it in January, and then it dropped a couple weeks after. So you just kind of need to be aware of what the potential is here. Now, history rhymes, but it doesn't repeat itself. So I wanted to use the original 4 stages of market structure chart just as a consistent reference. But you can see, maybe some of these markup and distribution lines get shifted to the left or the right, but you can get the general sense of the pattern. So again, I think in Durham, looks to me like we're in a stage 4 decline, lower prices. And I think we saw that in the last week or two. We dropped below $12. And $12 for me was a key level for a lot of reasons. It's a round number. Round numbers act as magnets, often bring in support or selling. And there's a Fibonacci level. I won't get into other technical indicators, but I'm a firm believer in the Fibonacci's sequences. And we broke below there last week, which certainly adds conviction to my bearish sentiment. So, canola looks to me like it's in a stage 4 decline. It may be, that stage 4 decline might have happened a long time ago, depending on where you want to draw it. But any rallies in canola, I don't trust any rallies in canola. It's a bear market rally, so I would say in a bear market rally, you want to know where there's levels of possible resistance and put in maybe sell targets there, or use the futures contract to go short. Feed barley. Yeah, feed barley's been an interesting one to me. Relatively volatile also. We broke through some key levels. I think I had a price target this fall. It was actually in August, so it's right up at the start of the crop year. And it's just been on a waterfall cascading down, following corn. But you can see just, if you have an idea where you are in the market structure, you can help make better decisions. Oats, again, I just find it amazing. I find it fascinating how these commodity price charts all follow the general price pattern of the market structure chart. So oats, if you look at that, we're in the stage 4 decline, but perhaps we're starting to consolidate sideways into, maybe we're forming a stage 1 accumulation, right? So we just need to keep an eye on that. Might be some opportunity in oats. We're still below our moving averages, so I'm not getting too excited, but if we get to start making a new high, for example, above there, then I think there's room for optimism. Canary seed. So I grew up in West Central Saskatchewan, and I got this love for grain marketing. So a mile to the east of my father's farm was Reinhold Nunwaller's farm. Now, Reinhold Nunwaller brought canary seed into Canada in the trunk of a car that he borrowed to drive down to, I think it was Texas, to bring the canary seed back, and then kicked off the canary seed production in Western Canada, and led to further development of the special crops industry, which was essentially non-existent at that time. So in West Central Saskatchewan, there's a number of processing facilities on farmyards that seed growers put up, or different farmers, and they would process grain for all-state grain, or commodity special crops for all-state grain at that time, and export them. And so anyways, I got a special tie to canary seed. As itchy as it is, it's an interesting story for me anyways. So again, we look like we could be in a stage 4 decline. It's hard to be optimistic, hard to be bullish, any of these charts, any of these commodities I'm looking at. Yellow peas seem to follow this chart structure a little easier, The key to be aware of right now is, we're consolidating sideways with yellow peas. Are we going to break up? Is this a stage 4 decline, or are we in a stage 1 accumulation? So we'll know more if the price breaks up or down. But right now, I'm betting on down, but we'll see what happens. Green peas, it looks like a state, we're making new highs, right? So we're still on the stage 2 markup. Can it go higher? Yes. Will it go lower into stage 3 distribution? Time will tell, but it's hard to, if you're a trend follower, it's hard to sell your green peas right now. I did have a sell signal recently, but my sell signal came because I thought my indicators were suggesting that we could be arriving at the end of the trend higher. So we'll see if that's right or not. Large green lentils, again, new highs, stage 2 markup. At some point, that trend will end. A lot of people suggest it's going to happen soon as new crop and old crop prices merge. But, right now, we're still in the stage 2 markup. And red lentils, a little trickier, but I think we're in a stage 4 decline. But, we're making new, it's broke out of that trading range, so maybe that's wrong, but I'm still thinking we're in a stage 4 decline, so. Yeah, anyways, so what I do, I publish 2 newsletters I mentioned earlier. I offer a complimentary free month. So there's 2 ways to do this. You can go to my pricing page. You can enter in your information. It'll ask for your credit card information. It will charge you at the end of the 30 days if you don't cancel, but you can cancel. The other way to do it is there's a form you can fill out on the first page, and I'll automatically add you to those newsletters. So I'm open to any questions. If you guys have any questions, go ahead, Trevor.
Who'd you go to prom with?
Yeah, well, I did find a prom date. It just wasn't Becky, but got over that anxiety and that depression.
I have a question. My question is, I'm not trying to be skeptic. I just find it interesting how you can grab a chart and size it to a time frame and then throw it into the cookie cutter of the emotional phases. And the one thing that I've learned is when in doubt, I zoom out and try to get a little bit more context of the history without getting too technical. So I'm just curious, like, how do you peg a chart into these phases from a time period standpoint, if that makes sense? And how do you know you're kind of in the right time frame to peg it, if that makes sense?
Well, that's a great question. So what's very important if you're a grain farmer or a day trader is to know what is your time frame. So I use the weekly chart. The weekly charts is the time frame here because the crop year is 52 weeks a year. You're on a longer time frame. So it worked especially well using the weekly chart because 2020 was the run-up the start of the markup stage. So I was able to overlay that. Now, if I could do the same thing with a daily Canadian dollar chart, CAD USD chart. I can do the exact same thing. I can do it on a 1 minute Google chart. It wouldn't matter, but because for our sense and purposes as grain marketers, and the start of the markup phase was 2020. That's why I chose that time frame. Now we could go the same thing on soybeans. We could pull it up on a daily chart if that's your time frame, or a 30-minute chart. It wouldn't really matter. I can get the same results. Does that answer your question? A little bit? Yeah. It's important to know your time frame. So what happens often is I get asked all the time, what do you think the price is going to do? And I followed up with, well, what is your time frame, right? When are you looking to sell in the next 2 weeks, next month, next 2 months, or is it 6 months away? Because you can get entirely two different answers. So it's important to know your time frame, and it's important for the analyst to know your time frame. If I think the price is going up and you're selling in the next 2 weeks, I think I don't think it's that great of an answer for you that I think the price is going up, because I think the price might go up over the next 12 months or the next 6 months, not the next 2 weeks, right? So it's very important to understand your time frame. Are you a day trader? Are you a swing trader with days to weeks, or a long-term investor looking at weeks to months? And as a grain farmer, you're likely on the weeks to months time frame.
So it looks like on most of what you were laying in there, it's about a 5-year chart that you've got up there, right? Is that about right? And how do you know if some of the charts are going to be 5 years where it's going to take that cycle, or maybe it's a 2-year cycle? And we're farming, so we're growing, like we got to sell grain every year, right? So we're not always, unless you have a lot of bins and a lot of money.
Well, I don't have a time frame on when this is going to be. All I know is we're in year 4, I guess, right? Or in year 4. I got to think about your question a little bit more here. I do get asked how long do these cycles last? How long does the decline stage last? And there is no one answer, right? There's no one answer, and it could happen really quickly. There's a potential that this would have been the stage 4 decline and stage 1 accumulation, right? We just never really know until after the fact.
It seems like we don't have the luxury of waiting 4 years to make decisions around the cycle, so that you have to zoom out to check maybe the trends and the emotions, but still make decisions within the context of the cash issue.
Yeah, a grain trader told me when he first started trading 20 years ago, his mentor told him that farmers sell grain for 2 reasons: cash flow and bin space, right? So understanding, you guys are fully aware when your cash flow needs are met and you need your bin space. But if you can identify when the trend changes, that is a time to exit your position, whether you need the cash today or you need it 6 months from now. Take the low risk make the low risk trade, and you break to a new low below a period of consolidation. As a trader, that's when you sell, and you just try to avoid lower prices. The pain of lower prices will impact you more than the pleasure of selling at higher levels. It'll stick with you. It burns a hole in your psyche. It's painful. So as soon as you break through that period of consolidation, make a new low and a downtrend, it's time to exit your position, regardless of your bin space requirements or your cash flow requirements. And if you're trading and selling canola, for example, I encourage all my readers and all my people that call me is, you have a futures account. Are you prepared to offset, take a position on paper for a fraction of the cost of ownership of the physical product. And if you're wrong, if you sell and you're wrong and the price goes up, let's try to capture some of that price increase on paper. And there's a variety of people offering that service and brokering and advice on that. And I help some guys out with what I would do in those situations. And the canola, for example, and you got the futures market. It's so valuable. It's such a powerful tool that can take away some of the emotion out of it. You could sell your canola and just decide, okay, if I'm wrong and the price gets back above 600, then I'm going to replace that canola on paper for a fraction of the ownership cost of the canola. Now, there's two secrets to trading futures, okay, and trading stocks. Number one is know when you're getting out when you're wrong. So before I enter any trade, I know when I'm getting out if I'm wrong. So say I'll use canola. So say I'm going to buy canola at 600, and I'm going to make a decision based on my analysis that if it gets below 590, I'm wrong in this decision, I'm wrong with this trade, I'm going to exit it below 590. And then what I'll do is I'll do a position size accordingly, so I don't want to risk all my capital in any one trade. It's a little difficult with futures, but there's a lot of leverage in futures. You can tie up cash in your futures account, but you don't want you want to avoid margin calls. And when you're getting advice from anybody about a hot stock tip of an oil stock or uranium stock or cannabis stock or whatever, or canola, and they say you should buy here, you should follow up with I recommend following up with the question. I always do. Where am I getting out if I'm wrong? Because you have to know that. You have to have a plan where you're wrong, because the capital drawdowns will kill you. Do I have a few more minutes? Oh. You do. Okay. So you want to know where you're getting out if you're wrong and position size accordingly. Basically, it's small bets, and that's the key to success. The best traders in the world, and I'll use Steve Cohen's recent quote in a magazine as an example. He's Steve Cohen, owner of the Mets, potentially the greatest trader Wall Street has ever seen. His team of traders and his funds, the best one he was quoted as saying was right 63% of the time with his trades. The rest were mid-50s. And that is considered a high success in trading. So don't expect to get every trade, every idea right. It's not going to happen. The best people with hundreds of people and billions of dollars at their disposal are still only right 50 to 60% of the time. But the reason they make money is they keep their losses small. So they have a plan in place where they're getting out when they are wrong in their assessment. They keep the losses small. Let your winners run, cut your losses short, and that's what we try to do in the markup stage. So.